Welcome to Family Office World Live. I love doing these. This is going to be really interesting, the call today. So I'm going to tee this up with a story. About 4 years ago, I was running a Tiger 21 meeting. And by the way, for people who are not familiar with Tiger, it is certainly, in my opinion, the best organization to be involved in from a networking standpoint, and they've done a terrific job. But we had a speaker for dinner, and the speaker was David Kaviller, and David was somebody that I had known from Northwestern, and he was one of the founders of AQR. And he gave a presentation on AQR on what was called tax-aware investing, and it sounded phenomenal. And I listened to it. I'm a glasses half full person, which is both good and bad. So I asked him if he'd fly out to Chicago to meet with one of the top estate planning attorneys in the country. He did that. I told the top estate planning attorney, I said, I will pay you per hour. Your job is just to poke holes in this, because what he's telling me is really, really interesting. And it's basically on tax-aware investing. He met for 5 hours, and he said, these guys have created a better mousetrap. Fast forward, AQR, and this is before AQR had done anything with tax-aware investing. They have now raised close to $100 billion in their fund on tax-aware investing. And of the 100, they're probably doing about $3 billion a month. So this is really where I'm starting to learn and hear more and more about tax-aware investing from the family offices that we invest. We have a syndicate of about 130 families. These are families between 250 million to 30 billion, and I'm hearing more and more of this. So that took place. I put together a conference with McDermott and with AQR on tax-aware investing, and we brought in 80 families. And at the conference, one of the things that was said was that the next thing, as many people as were talking about or asking about AQR and other firms, they're now doing that about ETFs, which again is another tax-aware investing. The third one is something called PPLI, which stands for private placement life insurance. And I have on this Zoom call, I would say the godfather, or certainly the top guy in the country in this space. So first, it's a pleasure to introduce you to Michael Liebeskind. Michael, it's a pleasure to have you here.
Thank you, Ron. Appreciate your inviting me to join.
Have you ever been referred to as a godfather before?
Once or twice before by you, actually.
Okay, sorry, my bad. In any event, it's great to have you. So we're talking about today's topic. It's about PPLI, but it's really more broad. It's about tax-aware investing, because I look at what you do is no different than what AQR is doing, which is no different than what Zach Wainwright's doing. It's basically because what's interesting and fascinating to me is if I'm in a if I'm investing in Citadel and they're up 20%, that's a moot point to me. The only relevant metric is they're up 12% after tax. That's all that matters. So it's after tax returns. So take a minute first, is give a little bit about your background first, how you got into the space, and then just from a 30,000-foot level, talk about what this is, because I look at this as something I call structural alpha.
All right, terrific. I started my career as an accountant at Coopers and Lybrand, which is now part of PricewaterhouseCoopers. After my learning curve flattened out there, I joined a financial planning firm, and that's where I first became aware of the tax attributes of life insurance. And I became sort of fascinated by that. The tax attributes for life insurance were inconsistent with what I had learned at Coopers and Lybrand, and very favorable. And so I really began to study life insurance very carefully. I was at that financial planning firm for about 6 years, and I decided that I wanted to build a professional firm with that expertise with life insurance. And so I formed a firm that became ultimately very successful. While I was at that firm and really leading that firm, I became aware of private placement life insurance, which is an evolution of the product set for life insurance, and it's sort of the most up-to-date version, or the most advanced version. And I really devoted myself to studying that. I got very lucky. I had a couple of clients who were running a bond trading desk for a very large Wall Street bond firm.
This was a Solomon?
Yes, and they spent about 9 months torturing me in their due diligence process. They would send me on an errand. I would come back and do the errand, and then they would talk amongst themselves, and they were talking in math language I actually didn't understand. They would send me on another errand. I would come back. And about 9 months into it, they felt comfortable enough to proceed with a substantial PPL acquisition. And through their due diligence process, I became more expert at PPLI than anyone that I knew. I had a broader perspective than anybody at any insurance company. Knew more about the law than any attorney. And so I said, okay, this is going to be a terrific market. We can be differentiated. And it was a long, slow, difficult process early on. But eventually the market now has matured to a point where, there are hundreds and hundreds of people on this call who are interested in the subject matter. So that's sort of how I came to it. What PPLI is in a nutshell. First of all, it's a life insurance policy, and it really is it exists at an intersection of 3 professional disciplines: income tax planning, estate planning, and investment management. And life insurance is what can coordinate all of that. Life insurance provides an income tax shield. So basically what we're able to do is we're able to create investment account structures that qualify to be taxed as life insurance policies. And why do we care about that? Well, life insurance policy is exempt from income tax if it's structured properly and if it's administered properly, which they all are. So a client that deposits cash into a PPLI investment account policy can generate returns for the rest of the lifetime of whoever is being insured, and they're never going to pay income tax on that money, whether they leave it in the account or they're permitted also to take tax-free distributions out of the account. So conceptually, it's an investment account structure with the right amount of life insurance attached to that structure so that the entire structure qualifies to be treated as a life insurance policy for income tax purposes and therefore exempt from income tax.
Now, when I first heard about this, My response was, okay, too good to be true. I didn't buy into it. And I never heard of it. Right. I invest with some of the wealthiest people in the world. And I had not heard, this was maybe 10 years ago. And then maybe 5 or 6 years ago, I started hearing more and more of my family offices that we invest with saying, yeah, you got to structure it this way. You got to structure it this way. And that's when I first learned about PPLI. And I think one of the reasons, like, how come I hadn't heard about it? And what I came to realize is, one, it's a very complicated product. Two, the commissions are very, very low. Three, um, not all insurance people have the intellect that you do or that other people do. So why would an insurance person sell a product that's low commission, very complicated, and they might not understand? But you were doing it 20 years ago, and the market was horrible, right?
Yeah, you had to have, in hindsight,
Yeah.
it was probably not a wise thing to do.
No. But you start. But so, what caused you to get into this? Because
I was intellectually curious, and these two geniuses came across my path. They had already chewed through three insurance brokerage firms. They announced that right off the bat. That I was their fourth stop. They hoped it was their last stop, as they had hoped for the prior three. And I was just determined to meet their expectations. But in that era, and I really thought, okay, got the first one done, and now it'll be, 0 to 1 is super hard, and 1 to be a lot easier, and 2 to 3 and just get easier and easier. But 20, and it was really over 25 years ago. But it was very, very, very difficult in the early days. For the reasons that you cited. There were a lot of forces against the development of this market that created real headwinds. You mentioned insurance brokers. Where's the commission? We don't really have commissions in the traditional sense with PPLI. We have asset-based fees, and we charge a structuring fee for the work we have to do in structuring. It's all fully transparent. It's all fully commoditized. So the insurance agents are used to getting paid heaped commissions, where they get most of the money, 90% or more of the money they're going to get over the lifetime of the policy, they get right up front. So it's difficult to transition from a traditional life insurance practice to a PPLI practice. The investment firms couldn't manage money in this environment, so the traditional investment firms, they discourage clients from exploring this. The clients or potential clients that were good candidates, they had never heard of it before. How could it possibly work the way you say it works, Michael? If it worked like that, everybody would be doing it. And I checked around. Nobody I know has ever done this. And my lawyer is vaguely uncomfortable with it, and my accountant's vaguely uncomfortable with it. And I'd work them through that and eventually build a level of trust where I would demonstrate that this is sound law, and it's built out of the long tradition of tax law for life insurance policies. And then they'd say, okay, all right, I believe you. Show me the roster of investments. And in that era, aside from the traditional asset class funds, we had only 2 funds in the alternative asset class arena, and they were both pretty lousy fund of funds.
So hold on. So if they were going to do this 20, 25 years ago, structurally it makes sense, but their options were extremely limited.
Yeah, and they would say to me, well, come on back and visit with me again in 5 years when you have more investment options. I said, well, how am I going to get investment options if there's no money coming into this market? So eventually, the most sophisticated clients they forged ahead, and they did PPLI, and they wanted a particular investment manager to manage the money, and they were doing it in a large enough scale that investment manager didn't want to lose their money. And so they built an insurance dedicated fund that could accept an allocation. And then that's how an insurance dedicated fund got created, and then another, and then another, and another. And eventually, more money was coming into the market, more fund options began to be developed. Some of the investment firms that were creating headwinds in the early days are now creating great tailwinds because they're active in this market. So it just took a very, very long time for something that made great sense just just as much sense 25 years ago as it does today to work its way into the mainstream.
But the difference being that today you've got hundreds of incredible options, whereas when you started, you had two marginal options.
We
Like,
have many, many, many investment options, and the client, if they want to, they have a particular investment manager in mind that they want to manage a customized pool of capital for them under an investment mandate that the client's actively involved in creating. They can have that too. So we have many funds. The clients can self-direct among the funds, or they can work with a trusted investment manager to manage the pool, a customized pool of capital.
so when I first heard about this, and I'm guessing it's maybe 7, 8 years ago, something like that, and then 6 years ago, in fact, I'm hearing more and more people, and now over the last 3 years, I'm getting inundated with people asking or talking about that. Like, for instance, one of the perfect, I think, use cases would be something in like private credit, right? So, private credit, I never invested in private credit because while many family offices did and do, to me, it doesn't make sense because, yeah, I'm getting 10%, fairly not taking a huge amount of risk, but I'm also, after taxes, if I'm in New York, I'm getting what, 5.5, 6%. It's not that great of a, what you guys do, and this is, you almost have to forget the word insurance because what you guys do is basically it's like structural alpha. You're structuring it, and the value prop is basically 50 basis points for no income tax. So walk me through that.
Oh, well, did a terrific job of summarizing that. The value proposition for PPLI is a very simple one, actually. Are you better off paying the fees for the PPLI investment account policy or the income tax that you would otherwise have to pay on the realized investment returns? And in an asset class like private credit, that's entirely tax inefficient, where you're paying the highest marginal rate on all returns, that value proposition is very, very, very compelling. And it doesn't take all that much to convince a client that they're going to end up with more money and compound more money. And you compound money on that difference, the difference between the fees. You mentioned 50 basis points, which is a good estimate for most PPLI accounts over the lifetime of the insured. If the return is 10% and we run an IRR at life expectancy on the premium deposits versus what is paid out as life insurance proceeds, that IRR is going to be about 9.5. So we'll lose around 50 basis points to PPLI policy fees. Well, that's compared to losing 400 basis points, or in some states, 500 basis points or more to income tax. Well, that is a very, very compelling value proposition. It has to be compelling because we're putting the word life right next to the word insurance. And when you say life insurance, enormous, vast majority of our clients have had prior experience with life insurance that was disappointing. So they come to the conversation understanding that this is a life insurance investment account policy, and they are rightfully skeptical because of their prior experience. One of the things that we see happening with clients, though, is they start by doing with their first deposit, that we have to sequence our deposits in to get optimized tax results. The first deposit is typically allocated, and we like to see it allocated to something like private credit, where the returns are highly predictable and the tax alpha is obvious. But once clients have their legs under them and they've been getting their reporting and then everything is working out the way it's supposed to, it begins to occur to them that paying income tax versus 50 basis points in a lot of other asset classes makes a lot of sense. Absolute return hedge funds would be an obvious example where it's tax inefficient. But even on the other end of the spectrum, something like private equity or venture capital, which is inherently tax efficient, can make sense for allocations because the expected return is so high. And there's still an awful lot of tax to be paid that can be avoided using this kind of a structure. But private credit's a wonderful example because in that asset class, and there are many, many wonderful private credit firms, there's just not enough investment alpha available to overcome the burden of income taxes versus the burden of PPI policy
Yeah.
fees.
So I'm getting a ton of inbound questions right now. And I would encourage anybody who's listening live on this, if you have any questions, just put it in the chat box and I'm happy to have Michael answer the question. First question we got that's coming up, I'll put it up on the screen, is from David Ortiz. What cases are you typically seeing PPI used? He said, I've generally thought of it as a G2 strategy where they will have decent underwriting in a long-term time horizon. I want to try to compact these because we're getting inundated with questions.
Okay.
So try to keep this as concise as possible.
Well, that's a wonderful question, an insightful question. With typical life insurance, we're usually insuring generation one, the matriarch and patriarch. With PPLI, for the reason David has cited, we often are insuring younger family members where the cost, the drag on return over their lifetime will be low from PPLI policy fees, and we have greater longevity for our income tax shield. There are 8 use cases that we see over and over again. One is just straight accumulation. You can accumulate money on a tax-free basis versus a taxable basis. So that's with no plan to really take money out. You can take money out, but you just plan to leave it in that income tax shield environment for the entire lifetime. Another would be to use it as a systematic distribution tool. Put the money in the PPI policy, let it grow for 10, 15 years, and then use that as a supplemental cash flow stream for either Gen 1 or Gen 2. And then we have a series of intergenerational wealth transfer strategies where we combine the income tax shielding of PPI with techniques for transferring wealth from one generation, typically generation 1, down to generation skipping tax exempt trusts where they're outside the estate tax system altogether. Sometimes clients will use the income tax shield in the context of a grantor trust, where the grantor has to pay the income tax, to eliminate or relieve that with a grantor of that particular tax burden. So this is an intersection, as I said before, of multiple disciplines. In that arena, our job, we think, is to minimize multi-generational income tax, but also if the family can handle the incremental complexity, as long as we're at it, minimize multi-generational estate tax as well.
It's interesting because one of the questions that a lot of my friends will ask me is, what's the difference between family office investors and ultra high net worth investors? And the word I always use is compounding, right? Like it's like their favorite word. And the tax efficiency on it. Right now, this has become an extremely hot topic. I don't know if it's the last 3-5 years, you know better than I. When you first started, there were only 2 options, right? Like, who are some of the players, if people want to invest, like, who are some of the players that are involved in this? Like, if they want to invest, like Goldman or,
Well, you mentioned Goldman Sachs, JP Morgan, they're very active in this market. In private credit, we've got, and I apologize if I'm leaving anybody out, but we've got Apollo and Blackstone and Ares and Golden Tree and Owl Rock and MGG and HPS, Neuberger Berman. There's private, Millennium is very active in this market, very popular, an absolute return hedge fund. They're open in their insurance dedicated fund, even when they're hard closed. Otherwise, this is very attractive money for an investment manager because it's very sticky, very stable. Clients recognize that they're in it for a long haul. And then there are many RIA firms, Corient and Crescent and Wealth Enhancement Group and Rockefeller, many others that are actively managing customized, separately managed accounts for clients. So and then of course in the registered fund arena, every major mutual fund company is offering a full array of traditional asset class vehicles, Vanguard, Dimensional Fund Advisors, T. Rowe Price, etc. Every one of these investment firms went through a process of diligencing this market to ensure that their brand image wouldn't be sullied in any way by being affiliated with this market. And the breadth of investment options and range of investment firms that are active in this market is a tribute to the reality that this is nothing controversial. We're taking a well-known tax law, statutory authority for life insurance investment account policies, and we're combining that in many cases with well-established techniques for multi-generational estate tax minimization.
All right, now I'm going to flip this and ask you the question through like a lens that I would ask. Okay, it's structural alpha. I get the tax benefits. Why wouldn't you do it?
So you touched right at the outset on probably the biggest obstacle, which is complexity. The more financially sophisticated the client, the easier they are for us to work with. They know what we're talking about. The logic, which they'll test, from 18 different angles, it all holds up and it makes sense to them. The business models of all the various players and why the various players are playing their particular roles all make sense. So it's not that complicated when you break it down into digestible bite sizes to build the foundation and then, the knowledge that the client will need in order to make an informed decision. There is, I should mention, I don't want to let this session end without mentioning that there is a constraint. There's a doctrine called the investor control doctrine, not directly grounded in statute, but enforceable. And we had a tax court ruling in 2015, which aside from a statute is the highest level of authority you can have under the tax law, that says this is an enforceable doctrine. The general parameter, and this is widely misunderstood. So I'll tell you what you can do, and then I'll tell you what you can't do. What you can do, if you're the policy owner, typically a trustee of a trust, is you can allocate to any of the funds the insurance company makes available. Traditional asset class and alternative asset class. And you can redeem out anytime you want. And as long as that money stays in the account or is taken out of the account in the proper way, there's no income tax. And then in addition, we have the ability for the policy owner to have a customized pool of capital, typically with whoever they want, really, as long as they're a capable investment manager, whoever they want managing that money. So those are the things you can do with tremendous, tremendous flexibility to make allocations, to take redemptions, leave the money in the account, take money out of the account. Once the money is allocated to a commingled, we call it insurance dedicated fund, or to an individually customized, we call it separately managed account, the investment manager must manage that pool of capital on a discretionary basis. The client's permitted in a normal reporting cycle to have transparency into the underlying holdings. The client, if they're not happy with how the money's being managed, can redeem out. But they have to allow the investment manager to manage that money on a fully discretionary basis with no direct or indirect influence on what they're buying. The investment manager is going to buy, hold, or sell to fulfill the investment mandate for that pool of capital. You don't get to call Izzy England or Millennium and say, buy Ford and sell GM. You don't get to call David Golub and say, don't make that loan, make this loan. So that is called the investor control doctrine. If the policy owner is influencing control over what specifically is bought, held, or sold to fulfill the investment mandate, that level of control makes the policy owner the taxpayer and defeats the purpose. What does that mean? In its practical matter, what that means is that all entrepreneurial activity, which is the source of wealth for the vast majority of clients we work with, all entrepreneurial activity needs to continue to occur away from these accounts. These are accounts where we're taking money off the entrepreneurial risk table and we're entrusting it to an investment manager or multiple investment managers to manage within the confines of an investment mandate. And I'm a big fan of entrepreneurial activity. There's no investment manager on earth that can outperform an entrepreneur on the return on capital generated from that entrepreneur's area of expertise. But it does make sense after a certain point of wealth creation to take some money off that risk table and set it aside for long-term tax-free compounding.
So it's clear that you don't like but love what you do. I mean, and that's a wonderful thing. And hold on, my question is, when I was younger, I thought I was going to be a basketball player, and then I stopped growing at 5'4", so that didn't work out so well. What did you couldn't have thought this is when I'm 12 years old? This is what I want to do.
Actually, when I first got interested in life insurance, when I was working at that financial planning firm, one of the things that attracted me to it was that all my friends were working on Wall Street, and then they were going to spend the rest of their careers trying to kill each other. And they were really talented. And the life insurance industry, the puzzles are really interesting. First of all, the tax attributes are completely unique. And I didn't know anybody who was in this industry. And I thought, okay, this is for my level of talent, this is a market where maybe I can be differentiated. And
but you were like the first, one of, if not the first player in this market, right? And
not the first. There are some folks that can trace it back further than me.
But you were one of the first players in the space. So when you look at it, let's talk about, okay, why wouldn't you do it? Like who
I mean, if you're not financially sophisticated, and this is not a question of intelligence, this is a question of financial sophistication, then you're never going to get comfortable with it. And if you're not comfortable with it, then you shouldn't do it. It's just not worth it to spend the rest of someone's lifetime with a structure that you don't really understand, that makes you uncomfortable. That's a good reason not to do it. Another good reason not to do it is if all your money, you got a business going so good that you got to put every last nickel into that business. You're compounding at 50, 60, 7% a year, and you're not ready yet to take money off that risk table. Then you're really not a candidate. If you in your family don't have anyone that we can insure, generally we have people we can insure, but if the matrons are too old or unhealthy, have adult children, we need adults to insure. Then that's very rare that we don't find candidates to insure, but that could potentially happen.
You're insuring the younger generation just because it's cheaper to do it than an older generation.
Lower cost. You have to buy more life insurance, but it's so much less expensive. It ends up being lower cost. And I think the equally great attribute is you have an extra 30 years of tax-free compounding under known tax law, where if it does change at some point in the future, this is an awfully good thing. If it does, the tax law change at some point in the future, existing policies that were put in force before the change in the tax law are almost certainly going to be grandfathered. So if that happens, I hope it doesn't happen. I don't think it should happen. It's a life insurance policy, same rules as all other life insurance policies, other than that we have transparency of fees and we can allocate to alternatives, which nobody should be bothered by. But if the law does change in the future and it's not as favorable as it is today, you're going to be awfully glad that you insured Generation 2, where you have an extra 30 years of tax-free compounding.
Is that one of the reasons why there's, I'm not saying a huge rush, but I'm hearing it more and more people want to do it. Is that one of the reasons? Because
I think familiarity, you're at the club and maybe your buddies have done it and you really respect them. It seems to be the people you respect the most who have done this. So that's very motivating. But also there's one senator in particular who thinks that this is too good and that the law, he recognizes that this is the law and that the law should change. We have favorable conditions in Washington today, but nothing is guaranteed for the future. And so clients, I think, are making a sound judgment that if this is something you're eventually going to do, doing it sooner rather than later is safer.
So when I'm guessing, certainly in my little world, which is strictly family offices, I'm seeing a huge percentage of them do it. When did you learn first about family office? Because I used to run a hedge fund. They used to call them rich people, and now they call them family offices. When did you first learn about family offices, and why has this become so popular, specifically for the uber wealthy?
Well, they have the money. So that part's pretty easy. They think long term. You mentioned that before. They're thinking multi-generationally. They're thinking about how to steward this money for the benefit of their family or charity. Money can only go three places ultimately. Stay within the family, which in this level of wealth means stay in the economy and generate economic growth, which I think is a good thing. Or it goes to charity, typically private foundations or donor advised fund, where it's going to get to people who need it. very, very efficiently relative to the government. And then third place the money can go is taxes. And most clients try to optimize for money that will benefit their family and the general economy, and through charitable enterprises, people who need it. They're going to pay plenty in taxes anyway.
I've got another question from the audience. I'll put it up on the screen now. Are you seeing financing of people? This is actually,
No,
I've heard,
not,
are you seeing financing of PPI premiums, and is a higher risk than traditional premium finance?
that's okay. It's an interesting question. As general matter, no. General matter, this is capital that has a liquid form, and the U.S. domestic insurance companies, which have the lowest pricing, are accepting cash as premium deposits. Offshore, the insurance companies will accept in-kind deposits, but any money that's transferred to a life insurance policy in kind is a taxable event if there's any gain within that asset. But it's not typically used in the context of premium financing. Now, we, as a firm, we're very active with traditional life insurance for ultra high net worth families as well. And each year, when the conditions are just right, we will do premium financing. And I believe that as a general matter, premium financing is oversold in the market, but there are certain circumstances where it's really a great fit for a client. In that circumstance, we do blend in a little bit of PPLI, typically around 30% of the overall portfolio. We get a lower advance rate, so we have to put up more collateral when we're using PPLI as part of the portfolio of life insurance in the context of premium financing. But we typically are getting higher returns than you can with a whole life policy or an index universal life policy, which is typically the policy form used with premium financing. So we like, and it creates more liquidity earlier on. So we have more flexibility and a little bit of how we think a safer transaction.
Now, you had a large liquidity event not too long ago. Did you do this? And just like, who did you insure? Did you insure yourself? Your kid? Talk about like what did you do?
It's interesting. People ask me all the time, what percentage of your investable account should be in PPLI? And I give an answer that sort of fits with what's in their mind, something like 10 to 30%. And that's obvious that those are going to be the slices of an asset allocation that are inherently tax inefficient. So that answer resonates with people. After you've been in this for a while, you've owned PPLI for a while, money that's invested away from PPLI with a traditional investment manager or a traditional portfolio, it really has to justify not being in the PPLI policy. So my own account, I'm a big consumer of PPLI. I have policies that insure my life. I have policies that insure my adult children's lives. That notion of maybe we should insure the adult children, that didn't occur to me until I'd been doing this for quite a while. It's pretty, some of the things that were innovated are now broad market norms, but that didn't occur to me right away. And there is a policy out there that uses group insurance, lives of non-family members, and that's something that in certain circumstances can be considered as well.
Got another question, getting a lot of questions. Got another question which I'll put up on the screen. Do you have any advice when it comes to working with family offices? Now, look, I this is my world, and I see, I often talk that 85-90% of family offices that exist, certainly in my opinion, shouldn't exist. And again, I don't judge anybody, but there's the problem is there's no metric for family offices. So because somebody sells their widget company for $5 billion doesn't necessarily mean they know how to invest, right? And there's really no playbook. And one of the things I found with family offices, it's so fragmented. It's a very inefficient market, and it's very siloed. And so few make it to the second generation, and the second and the third and the fourth generation. So the model itself doesn't work. And one of the things that I found is intuitively you would think, well, if somebody's worth X, there's a direct correlation between the level of sophistication and the level of wealth. That's not the case. And one of the things I found is, like with family offices, Some people will start a family office. They'll sell their widget company for $100 million, which is a ton of money, and that's just not enough to have a family office. And you really need a bare bones minimum in order for it to make economic sense. And we just put together a program at University of Chicago Booth, which I spearheaded with Paul Carbone and Steve Kaplan and Stephen Roach and a few other people. That you need a playbook to do this, right? But the playbook is, people have a liquidity event. Typically, they start investing from day one. I would argue that the first person they talk to before they talk to an investment guy is an estate planning attorney. Would you agree with that, and why?
Well, hopefully they would have talked to the estate planning attorney long before the liquidity event emerges, because there's tremendous opportunities. This is not in my direct lane, but there are tremendous opportunities to remove assets, entrepreneurial assets, from the estate tax system before the appreciation in value is recognized. And it's a shame when, and it happens, someone's so busy working on their business that estate planning is not the most pleasant subject in the world for some people, that they get very, very, very rich before they've done any estate planning at all. And it's pretty easy to remove the appreciation, or at least the appreciation over a low hurdle rate, from the estate tax system. It's difficult to remove principal that has emerged on your personal balance sheet from the estate tax system. And at every generational level, you have to pay an estate tax of in the neighborhood of 40%. That really puts a big dent on family wealth over time. And it's one of the big reasons why families are not able to preserve their wealth. But at any point when there's a liquidity event, what happens is typically they're going to be called on by every major investment firm, and all those investment firms say, hey, you should invest with us. We're differentiated because we have tax-aware investing with very sophisticated tax mitigation strategy, and that has a name. And then you lift the hood, and it's always tax loss harvesting. Now, I'm a fan of AQR and the leveraged tax loss harvesting stuff that they've created, and I'm actually a client of that, and that's a wonderful thing. But for a typical liquidity event, the problem is that if you start to do tax loss harvesting, the cost basis of your account becomes a smaller and smaller percentage of the overall account value, and the money feels trapped. Now, it's not a problem if you're holding the money on your personal balance sheet, because you'll eventually get a step up in basis at that.
So this is when a portfolio becomes ossified, correct?
Right. Exactly.
Okay.
Exactly. Now, if that happens on a personal balance sheet, okay, great. You're going to get a step up in base at death. But any assets on the personal balance sheet go through this gauntlet of estate tax, generation after generation. If that ossification, if that's a word, if that ossification occurs on a portfolio that's owned by an irrevocable trust, a trust that was funded with grants, we call it a grant remainder trust, or a trust that's outside the estate tax system for hundreds of years, we would call a generation skipping transfer tax exempt trust. Those trusts, the irrevocable trusts, there's never a step up in basis. So when that money gets trapped, it's really feels trapped with permanently. And that's a terrible outcome. What we would hope is that when the liquidity event occurs, before they go into the tax loss harvesting program, and have their basis start to become a smaller and smaller percentage of the asset value, that we would have a chance to talk with them, because that's the perfect time to put some money in PPLI. With PPLI, regardless of where the asset is held, we're going to have tax-free compounding. We can get to liquidity tax-free. And ultimately, when the insured dies and everything comes out of the policy, it can take time, if we're in illiquid assets, it converts to cash. When that cash pours into our irrevocable trust, our generation skipping transfer tax exempt trust, it carries a full cost basis. So one of the less appreciated virtues of PPLI is that we get a generational refreshing of the cost basis of the portfolio, because life insurance proceeds are free of income tax and paid in cash. So the perfect time for us to meet a client is when they've had a liquidity event or are about to have a liquidity event, and they're being patient and they're exploring a range of alternatives before they just turn that money over to a money manager to do traditional tax loss harvesting strategy.
So again, I look at what you do. This is structural alpha. I look at what you do as no different. I mean, are you a competitor in some senses to what AQR does?
I don't think so. I think that that those strategies are compatible. If the liquidity event already occurs, and if it occurs early enough in the year, or if you're forcing the liquidity event, you're trying to reposition an ossified investment portfolio, using the leveraged tax loss harvesting program to generate enough losses in that taxable year to offset the gain and defer the tax is a wonderful thing. And what AQR and others have created is just an incredible achievement, and it's producing an awful lot of value for people. What I'm doing personally is pairing that strategy.
That's my question. Can you combine that? That's my question.
Yeah, I think it's a wonderful pairing. So you go through your year, you do that strategy, you've now deferred your gain. Good for you. Then you can ratchet back on the leverage, reduce your risk in that portfolio, but still generate losses. When you generate losses, you now have the opportunity to harvest some of the gains, and that creates liquidity. And if that liquidity, which is what I'm doing, is then deposited into PPLI policies that insure, in my case, the lives of my adult children, now I've built a pool of capital in PPLI from which the kids, if the trustee decides the kids need the money, the trustee can draw down from that tax-free. And then ultimately, when the kids die, and everybody eventually dies, and the money comes out of the policy and into the trust, it's not only tax-free, but it's going to have a fully refreshed cost basis. So I really like the pairing of those strategies, and I'm doing that myself.
So I'm looking like this is like you're like a kid in a candy store talking about this, but for many people, this would kind of be boring or geekish, or however you want to determine it. So like just a question. What do you do for fun? I mean, how do you outside of this? Because I could see how passionate you are about this, and it's clear, and obviously that's why you're best in class. What do you do for fun? Like, what do you do other than? And it can't just be I play with PPLI policies.
Yeah. Oh, I will. Before I talk about what I do for fun, what I do is the greatest thing you can do. The puzzles that we work with and optimizing for multi-generational income and estate tax minimization are very, very, very interesting. And you were asking about family offices before. They're all different. They're all unique. And the people that we get to intersect our lives with they're just the most interesting people on earth. And I did have a period where I was between companies 20 months, and I found out in that period of time that I actually really don't have any hobbies that I'm any good at. I play golf. I'm terrible at it. And I love it, and then I hate it, and then I love it again, and then I hate it. And so I know that there's nothing else that I can do that will allow me to intersect my lives with the people that I have the privilege to intersect my lives with. And I also have an unpleasant talent of building operating companies that require intense administration. And I don't love that in the moment, but boy, do I love the feeling of building something, and particularly building the philosophical alignment. And I finally have this now in my career, philosophical alignment with a generation two leadership team that has talent and diversified skills. And, we're all pointing in the same direction, and, it feels great to help them achieve their ambitions and be honored, by them for what I'm able to teach them and enable for them. So I feel very, very fulfilled professionally. Personally, I have 4 wonderful, wonderful kids. I absolutely adore them. I lost my wife 20 something years ago. The kids and I, just became super, super tight. They helped me as much as I help them. They all have wonderful marriages. I got 3 great little people now who I adore, and 2 more on the way. And so, that's a very, very, very fulfilling life.
No, so I've gotten a chance to know you over the years, and you've got a lot of good qualities, but you're certainly one of the most ethical people that I've ever met. So when I ask the next question, you're going to answer it honestly. You ever dream about PPLI? Honest.
Sometimes. Sometimes. So I had a period in my career where I dreamed about work. I would go to sleep and I'd work all night, just dreaming about it. And then I had this great period where I didn't, and now I'm back to dreaming about it quite often. Usually, what I'm dreaming about is uh, something in the operating company that could use a little incremental optimization. And I don't know why, but a lot of those things emerge in the middle of the night.
So one of the questions, we've got about 10 minutes and then we got to wrap this up. I could talk to you about this for hours. Um, but one of the questions that I ask every guest, and this is in PPOI cannot, and structural alpha cannot be the answer. What are you most grateful for? Because one of the interesting things is I've gotten older, I've learned, I used to think that happy people were grateful, but it's not that, it's actually flipped in general. Grateful people are happier in general. So outside of this geeky little niche that you're the best in class in, what are you most grateful for?
Well, I'm grateful to be alive. I think it's an absolute miracle that we exist, and I believe we do exist. I believe that you're you, and that I'm me, and I believe I'm grateful for the. I mean, look, all of the incredible gifts. I'm not just alive; I'm human in this moment in time. I had wonderful, wonderful parents, and grew up in an environment of trust and teasing and laughter, and I had a paper route and a dog, and friends with my mom would kick us out of the house in the morning, and go. You can go back for lunch, but otherwise, I don't want to see you until the end of the day. And it's just an incredible. It's just an incredible gift to be alive, and then with all of that, to be able to intersect my life and have love. The love that I experience with my kids and with my friends, and we don't express it that way, but they're the relationships we have that emerge out of business that are very long term in nature, and the stuff that we do, everything gets better and better over time. The outcomes are better and better over time as things are compounding. It can be very intimate. I'm interacting with people when they're very expansive in their thinking. What's the meaning of their life, and how are they going to apportion the wealth that they've been able to create, or they're stewarding. How do they apportion that between charity and family, and I really catch them at a philosophical moment, and then we do medical underwriting. So I end up knowing more intimate things about them than perhaps their spouse or their friends, and we are trusted to compartmentalize that information, which we do. And so the combination of all those things allow the relationships that we're able to build to grow stronger and stronger and stronger over time. And I have to say, I'm incredibly grateful to my colleagues at my office, particularly my Generation 2 leadership team. They have shown me kindnesses that I didn't think I would experience in my career. And just to see them succeeding the way they're succeeding and leading others who are on a path to the same kind of successes, it's just incredibly
Yeah, I remember
gratifying.
you brought over like one of the top. I call him kids. I mean, he's probably in his 30s, but you brought over one of the top kids from Crescent, and I'm very active in Crescent senior back. So Aidan, I think he probably he works for you now. I think you hired him from Crescent. I think he wrote, at least in my opinion, and I'm not the expert, the best white paper in the market.
I agree.
Okay.
And no, he's a generational. I feel like the four leaders in our generation too. I wouldn't trade them for anybody in this market. I think they're just incredibly talented. But what I admire the most is that they're willing. That we have a philosophical alignment. We are here to serve the clients over very long periods of time. We're committed to being independent. We're committed to being a multi-generational partnership. We're not taking outside capital. We are here to serve the clients, and they're aligned for that. And the work is hard. I'm a tough taskmaster. I have high standards. I acknowledge that, and they're gritty, and they're doing it, and they're building the disciplines that are necessary, and they're expanding. This is not me leading them. They are now stepping forward into the lead, and they're expanding us and our capabilities in ways that I wouldn't even have imagined to be possible.
Yeah.
It's great.
And again, through you, I've gotten a chance to know Aidan now. He's brilliant. Got a very thick accent. Am I the only guy that do you mock him about that, or is it just like?
No, people love his Irish accent, but I do have to acknowledge Collier, who runs our design department. He's a data scientist and just absolutely incredible talent. His intellectual curiosity has no bounds. Matt Lerner, who joined us from BlackRock, is running our implementation team. His attention to detail and his organizational skill, and he's just doing a super job. He has the largest team in the company. He's doing a great job of leading them. And Jimmy Vu is my old friend. I've worked with him for over 15 years, maybe closer to 20. He was side by side with me in building some unique technology that serves our clients and automates an awful lot of the promises that everybody makes, and we're now built out to deliver. So they're just a great crew, and they really like each other, and thankfully they have complementary talents. And so we've got redundancy, but we've got some unique abilities that can advance us in various ways.
Yeah, I think one of the things that impressed me about you initially is you've got obviously you're best in class at what you do, but you've built a great culture, and that's not easy to do. What lessons have you learned early on that kind of helped to shape who you are, or how you're going to run your company?
I think a really important quality for people to have is the ability to get back up. We are going to get knocked on our butts over and over again over the course of our lives. And when you have gotten up enough and dusted yourself off enough and gotten yourself reoriented and found a path forward, at a certain point you gain confidence. You just know you're going to get up, and that you can be kind of a little bit calmer about what's coming day after day, what problems you might have to solve, because you just know that one way or another you're going to move forward.
So last question before we have to wrap up. You tell our audience, like, how can they learn more about what you do and how to get in contact with you?
Well, okay. There's my contact information coming onto the screen. So I guess
that was not you.
Whatever. I think you're supposed to put your phone in front of that, and then you press the button, and now you've got me.
I do the thing. I was at the conference, and you do the things where the phones touch each other, and then it exchanges things.
Oh yeah, that's a good one.
I always have.
That's a good one.
How to do that. Okay, well, listen, this has been fantastic. I think that what you're doing is very cutting edge, and it's just interesting because at least the investors that I invest with, almost like the wealthier they are, the more likely they are or more sophisticated and wealthy they are, the more likely they've entertained or have actually done PPLI. So this has been terrific. I very much appreciate your time. I appreciate the fact that your friendship over the years, because I've gotten to know you, and as good of you as you are in what you do in PPLI, which I sometimes mock you for, because it's kind of a geeky thing. I think you're as good, if not even a better person. So I'm grateful. I'm going to take a grateful one. I'm grateful for a lot. One of the things certainly grateful to gotten a chance to know you. And I wish you continued success, and thank you very much for coming on this.
Well, I feel exactly the same way about you, as you know, and I'm very grateful for our friendship, and thanks for having me.
Who do you think likes each other? Do you think you like me more, or do you think I like you more? Honestly, because you're honest.
I like most people more than they like me, so I think that's pretty safe to assume that I like you more than you like me.
I think that's fair. Thank you very much.
All right.